In reality, it just works for the financial industry. Now, in the next hour, I would like to share with you 6 surprising things that you probably didn't know about investing. And these 6 things are also the main reason why people have disappointing returns when investing. Now, if you want to get rid of the financial stress and headaches, if you want to save a lot of money, if you want to win the financial game of life, then this session will be a lifesaver for you. Now, it may surprise you that 10 years ago, I had no clue about investing. I had no clue about money management. I was totally financially illiterate. You know, I was born in a very small country called Slovenia, and Slovenia only has 2 million population. And I was born in a backwater village in that country, and my parents were blue-collar workers, earning minimum wage. And I had no special talents. I was average in school. But I was lucky that in my student years, I started my own company, my own business. And after 5 years of hard work, my business became very profitable. And I started to earn a lot of money. Now, if I just connect this to Robert G. Allen's session in the morning, you know, I was very good at wealth creation in business, but I had no clue about personal finance and investing. And because I knew that investing is a must, because you know you want to provide for your family, you want to provide for your pension, and so on. You know, I knew that investing is a must, and I didn't have a clue about investing. Who did I trust? What do you think? Who did I trust with my money? Financial advisors, bankers, gurus, and so on. So year after year, I just gave them my money. And after several years, I decided to check what is going on with these investments. So I ordered all the account statements. And when they arrived, my heart just stopped. I couldn't believe it. Money that I worked hard in my business to earn was mostly gone. It was totally devastating. And that drove me to make perhaps the most important financial decision of my life. And that was, I will become one of the most financially literate people in this world, no matter what. So in the next 7 years, I invested heavily in my financial education. I visited all the best seminars in the world about investing and money management. I read more than 300 books, but the most important thing was that I started to research what is going on behind the scenes of the financial industry. And my findings shocked me. And that is why I even wrote a very famous book about all that. The $1 Million Decision. And later on, I also started to develop my own system of investing that I now use personally, and I also teach to my students. It's called the Millionaire Money Making Machine Investing System. And I believe that my findings will also shock you today. So, let's take a look at the 6 surprising things that you probably didn't know about investing. The first thing is that small fees, small commissions can mean big problems. Now, when somebody sells you an investment product, so when you talk to your financial advisor, to your banker, to your broker or whatever, they are selling you different investment products. And they always show you how your money can grow over time with the help of the most important investment principle that is called compounding, compound interest. Raise your hand if you know what compound interest is. Okay? So we all know about that, you know? And when they show you how your money will grow, they show you something like this. Let's say that you have 1,000 euro or ruble or whatever, you know, it doesn't matter, the currency doesn't matter. And let's say that you have 10% annual growth. Okay? So after 1 year, how much will you have? 1,000 plus 10% equals? You can answer in Russian. Okay? So it's 1,100. And then the second year, it will not be 1,200, but it will be 1,210. Why? Because the compounding doesn't only work on your principal, 1,000, but also on the previous interests. Okay? So you get more money each year. And over time, your money can grow really fast. So in 40 years, with the help of compound interest, compounding, you will amass quite a large amount of money. 45,000 euro from your one-time investment of 1,000, okay, over 40 years. Now, this is 45 times your original investment, and you are on this exponential curve. That is why also Albert Einstein said that compounding is the eighth wonder of the world. But now comes the kicker. Nobody in the financial industry will ever tell you that compounding also has its dark side. And because of the dark side, people lose millions and billions of dollars that should rightfully be theirs. Now let me explain. And here pay attention to this, because this is the key to your success in investing. Okay, this is the key. This is the key that unlocks the potential for amazing returns in the future for you. When you invest your money in different financial products, you always pay a small fee. Okay? There is always a small fee associated with investing in different investment products. Let me tell you an example. Let's say that you invest in the most popular financial product in the world. It's called mutual fund or wzajemny fond. Okay? Wzajemny fond. So you invest in this vehicle. This is the most popular financial product in the world, and most investors in the world are investing in mutual funds. So what is mutual fund? Mutual fund, I will just be brief, is just a basket of stocks. Okay? So you are not investing in individual stocks, but you are investing in a large basket of stocks when you invest in mutual fund. So maybe it's 200, 300, 500 stocks at the same time. Now, when your financial advisor tells you that you should invest in mutual funds, they will also tell you that there is a small management fee that you will be paying. And this management fee is usually around 2 to 2.5%. In Europe, in Russia, and in most of the Asia, it's around 2.5%. So 2.5% every year, management fee. But what they never tell you is how this small fee affects your long-term returns. Let me give you an example. When you invest, let's say, 100,000 ruble or 1 million ruble into a typical mutual fund, you are paying this small 2.5% fee. And you think, okay, this is not a big problem, because they take 2.5% and I keep 97.5%. So this is not a big deal. This is not a big problem. Right? Wrong. The problem is that our brains can only do simple calculations for 1 year period. But when you add a longer time period, our brains cannot process the math anymore. So that is why our brains make some assumptions and approximations. So your brain goes, if 2.5% management fee is not a problem in 1 year, then it shouldn't be a problem over the long time period. But here, our brains fail us badly. Let me show you a concrete example. Let's say that you invest 10,000 euro in a typical mutual fund that has 2.5% management fee, annual fee. And let's say that you invest for 20 years. And let's say that on average you have 8% annual return. Okay? So 8% average annual return. Now, if there were no fees, okay, so this is just a theoretical example now. If there were no fees, you would keep all the returns. So all the market returns would be yours. So after 20 years, you would have 36,000 euro of returns plus your original investment. So altogether, you would have on your investment account 46,600 euro. Is this clear? Yes or no? Yes? Okay. But now, let's see what happens when we add 2.5% management fee. So with these fees, your returns would only be 19,000 euro instead 36,000 euro. So a small annual fee ate up most of your returns. Almost half of your returns are gone because of a small management fee. So this is your returns, and this is everything that is taken by the financial industry. And nobody in the financial industry will ever tell you about this concept, because it's not in their interest. So, as a rule of thumb, a small 2 to 2.5% commission, annual commission that you are paying with the most popular products in the world, approximately halves your investment account in the long run. So you only keep half of the potential profits, money, and the other half is taken by the financial industry. Let me give you a real-life example, because this was just theoretical till now, okay? Because in real life, it gets even worse. Here is a simple comparison between two funds. The blue line here is one of the best mutual funds in the world. It's called Magellan Fund. Magellan Fund. It's one of the biggest and most popular mutual funds in the world. So this is Wzajemny Fund. And the red line is an average, not one of the best, but average index fund, ETF. Okay, so what is the difference? The difference between mutual fund and index fund is simply in commissions that they charge. They both invest in stocks, in basket of stocks. Okay? Mutual funds and index funds invest in a basket of stocks. But when you invest in mutual funds, you are paying 2 to 2.5% annual commission. But when you invest in index funds, you are paying less than 0.5% commission. So much lower fees are associated with index funds. And if you have invested 10,000 euro or 10,000 ruble or whatever, a couple of decades ago, in each of these products, with mutual fund, you would now have 14,000 euro. But if you just invested in a vehicle, in a product that has lower commissions and fees, you would now get 57,000 euro on your investment account. It's quite a difference, huh? And the stocks, why did I choose these two funds for comparison? Because they invest in basically the same stocks. So the only difference is just the difference in commissions. So if you have low commissions, you can keep much more money than if you have high commissions. And this concept is so powerful that I even named it the commission camouflage effect. So in my book, The $1 Million Decision, I call this effect the commission camouflage effect. And this effect states that small commissions can eat up most of your future returns when you are investing. This is one of the deadliest concepts in investing, and just by getting to know it, you can save a surprising amount of money. Let me give you an example. A couple of years ago, I had a seminar in Romania, in Bucharest. And one of the attendees was a woman who was one of the most successful business owners in Romania. And when I talked about these commissions and fees, and then we had a break, she came to me. She was an older woman in maybe her early 60s, late 50s, early 60s, some gray hair with glasses. And she came to me and she was stuttering. And she said, Robert, 15 years ago, I invested more than 1 million euro in a Luxembourg-based mutual fund. And I didn't even know that they charge these commissions. I didn't even know it. And now,
И теперь, когда вы мне рассказали все вот это, я проверила в онлайне, какой процент за управление моего ПИФа, и оказалось, что это 2,7%. 2,7%. Мы сделали расчеты.
No translation? Okay, let's wait a bit. Yeah. So just tell me when to continue. It's okay? Okay, perfect. So she invested more than 1 million euro 15 years ago in this mutual fund. And she checked during my presentation how much is her management fee that she is paying every single year. And she said it's 2.7%. 2.7% annually. And we did some rule of thumb calculations, and we calculated that if she just chose a better vehicle, for example, index fund, she would have more than 2.5 million euro more on her investment account right now. So not knowing about the commission camouflage effect cost her 2.5 million euro. And even if you invest smaller amounts, it doesn't matter, because everything is just percentages, you know? You will always lose a large proportion of all of your future returns if you invest in vehicles that have high fees. So, remember, always pay attention to the fees that you are paying, because small fees can be a devil in disguise and can eat up most of your future returns when you are investing. And that leads us to the next surprising thing about investing, and that is that the most popular financial products suck, are really bad for us. Unfortunately, the financial industry, when we invest our money in different products, the financial industry is very highly motivated to sell us the worst possible products. The worst possible products. Let me give you an example. So, if you had to choose, let's say that we are selling financial products, okay? So we are selling financial products. Now, if you have two choices what to sell, if you sell mutual funds, you will get, or we will get, 2 to 2.5% of all the account holdings of all our clients every single year. So, if we sell mutual funds, we will keep 2 to 2.5% of all the money that our clients have on their accounts. But if we sell index funds, we would only keep 0.04 to 0.5% of all the money that our clients have on their accounts. And now the key question. Which products would you be more motivated to sell? Who thinks that financial industry is more motivated to sell mutual funds? Raise your hand if you think that financial industry is more motivated to sell mutual funds. Okay, perfect. So this is the big problem in the financial industry, that all the people who are selling financial products are very motivated to sell the worst possible products. Because when you buy mutual fund and you pay high commissions, you will get less returns in the future. It's that simple. So the higher commissions you are paying, less will be your returns. So this is the big problem, the motivation to sell. So remember, the most popular financial products are the worst ones for investors, for all of us. The most popular financial products are the worst ones. Number 3. Surprising thing about investing, number 3. Gold doesn't shine so brightly as we think. People love gold. Why? Because gold has always had a special place in our history. Gold was always associated with gods and kings. Wars were fought over gold. If you had gold, you had power, you had glory. That is why people love investing in gold. And a lot of people that I meet invest quite a lot of their money in gold in order to get great returns. And people really think that when they invest in gold, they will get great returns. But unfortunately, this is just a myth. It's not true. The truth is that gold didn't even outperform bonds over the long run, historically. So gold gave us, historically, very disappointing returns. Let me show you this chart. This is the chart of the real returns after inflation. So real returns means that inflation is accounted for. So real returns for different asset categories for the long run, so for almost 100 years. And as you can see here, the blue line here is large stocks. And then we have bonds. So red line is bonds, green line is short-term bonds. So red and green are bonds. The pink is the dollar, so if you kept your money under the mattress, and the gold is the yellow one. But because you cannot see the differences here, I will show you a more detailed picture now. But as you can see, large stocks outperformed everything else by a huge margin. Let me give you the details. So if you have invested $1 in stocks almost 90 years ago, you would now have 451 times the purchasing power. So 1 grew to 451, real purchasing power, after inflation is accounted for. If you invested the same amount into bonds, this $1 invested would give you $10 after 90 years. But if you invested in gold, you would only have 6.5. So gold didn't even outperform bonds over the long time period. And if you kept your money in cash, in paper money, it would lose most of its value because of inflation. So that is why my relationship with gold is very simple. I don't use gold as an investment where I would expect great returns, but I only use gold as an insurance, as a vehicle to keep my family safer, more secure. Now, in what cases, so against what? Insurance against what? Why do I need this insurance? Why do I need gold? And the answer is, if something goes terribly wrong in this world, then I will need gold. If something goes terribly wrong in this world, if there is a big war, if there is a hyperinflation, if the aliens invade, then I will need gold, okay? So only if something terrible happens in this world, I will need gold. Otherwise, I hope that I will die with all my gold. Because this would mean that nothing really terrible happened over the course of my lifetime. So I never intend to sell my gold. I will die with it. And like I said, gold, never invest in gold in order to get good returns. Always invest in gold just for insurance, just for safety. And like I said, my philosophy is never to sell this gold. I never intend to sell my gold. And I hope that I will achieve that, because this would mean that nothing terrible happened. Next big mistake or next surprising thing about investing is that short-term trading is a death warrant, is death. What do I mean by that? Raise your hand if you have ever heard about Forex trading or something like this, okay? So a lot of people are trying to get rich quick by trading Forex, by trading stocks all the time, by trading cryptocurrencies. So by trading, I mean short-term trading, okay? You buy now and you sell in 2 days, or you buy now and you sell in 5 minutes, or you buy now and you sell in 2 weeks. So this is short-term trading. And a lot of people are staring at their computer screens for hours and hours every day and making these trades and hoping for a big profit. But here is the reality. Let me show you a short video that I prepared about what kind of results you can expect from short-term trading. So let's watch this video.
Top 5 reasons why trading Forex, binary options, or stocks will wipe you out financially. Reason number 5. Life expectancy of an average Forex trader is just 4 months. In other words, the average Forex trader loses all of his or her money and drops out of the market after 4 months. That is why Larry Harris, the former chief economist at the Securities and Exchange Commission, said, "The business model for Forex trading is to burn the customer and then find another one." Reason number 4. Short-term trading is not only a zero-sum game, but a negative-sum game. In the trading world, the total of all wins and losses for all the traders adds up to 0. That's a zero-sum game. But when you account for the commissions and fees the brokers charge, the game becomes a negative-sum game. That means that the traders as a group are losing money all the time. And of course, the only winners in this game are the brokers and a few professionals. Reason number 3. Apart from losing money, you're also wasting your time. Most Forex gurus claim that you only need a couple of hours per week to become a Forex millionaire. That's an outright lie. Short-term trading is very time-consuming. In the best-case scenario, you need several hours per day for trading. That is why even successful short-term traders can easily have negative real return on investment when they account for the value of their time. Reason number 2. Your chances of succeeding at becoming a pro are next to none. According to the industry's own data, less than 5% of all short-term traders are profitable. Some studies suggest that less than 2 out of 1,000 traders can count on trading for their financial survival. In fact, you have a whopping 30 to 50 times better chances of creating a successful business than at succeeding as a short-term trader. And reason number 1. Nobody's life gets better because you trade, except your broker's life. When you trade, you are not building value. Trading the markets is a totally self-centered activity. The world doesn't get better because you do it. People's lives are not getting better because you do it. Except your broker's life, of course.
So, from my own experience, I can tell you, never go into the short-term trading. The example that Robert G. Allen was talking about in the morning was my example. I went to London to learn from the best how to trade Forex and stuff like this years ago. And all the people who are going to these courses are just losing money. After years and years of training, less than 5% of people are making some money. All the other people are just losing money all the time. So never go into the short-term trading game. So this is what Warren Buffett meant when he said, don't make mistakes. Don't lose money. In the short-term trading world, you will lose your money. Okay? It's much better to just be passive. And that leads us to the 5th surprising thing about investing. And that is that passive investing outperforms all the active strategies combined. The most notable example, because here we talked about individual traders, but what about Wall Street professionals? What about the biggest gurus in the world, the highest paid gurus in the world? Can they succeed with active trading? And the most notable example of active strategies for investing are hedge funds. Hedge funds. Hedge funds are different from index funds or mutual funds in a way where index funds and mutual funds can only invest in stocks and maybe bonds. So index funds and mutual funds, they can only invest in stocks and bonds. But hedge funds, they can invest in anything. They can invest in stocks, in bonds, in precious metals, in oil, in cryptocurrencies, in derivatives, in all the possible financial vehicles they can invest in. And apart from that, they can constantly trade with these vehicles, with all these instruments, and they can also short the market. So they can win, they can gain when the market is falling down. Okay? So this means that they are shorting the market. So hedge funds have all these possibilities at their disposal. And they can actively trade all the time. And they also do it. That is why hedge funds are an investing vehicle for sophisticated and wealthy individuals. Now, In theory, you would say that this vehicle, hedge funds, will outperform everything else because it's active, it's for wealthy individuals, it's, they are ran by the biggest experts in the world, and so on. So you would say this will outperform everything else. But the reality is quite different. Let me show you a cover of a magazine of Bloomberg Newsweek that summarizes the performance of hedge funds in a very simple picture. So, the myth of hedge funds is that you will get great returns when you invest in them, but this is the reality. This is the reality. So, more than 75% of all the hedge funds are underperforming the market. And the differences between the returns that you can get with passive investments like index funds that don't trade all the time, when you invest in index funds, they are just keeping a basket of stocks and they are not trading these stocks all the time. So the difference is huge, and that is why also Warren Buffett made a famous bet 10 years ago. So let's check it out. 1 decade ago, Warren Buffett took a $1 million bet that stashing money in index fund would make you richer than if you entrusted it with hedge fund managers. The other side of this bet was Protege Partners. This is a famous Wall Street company that sells hedge funds. And the results were, Warren Buffett said, investing in a simple index fund that follows the S&P 500 index, so this is the 500 biggest companies in the United States, he got 125% returns in 1 decade. Hedge funds only had 36% return in the same decade. And Warren Buffett got $1 million from Protege Partners, and he gave it to charity. He gave this sum of money to charity. So, simply investing in a very passive index fund can outperform hedge funds, the best managers and so on, by far. And that leads us to the last, 6th surprising thing about investing, and that is that monkeys can predict better than Wall Street professionals and gurus. Anybody knows who this woman is? Baba Vanga, you're right. Baba Vanga, she's from Bulgaria, and she is a famous prophet. And she correctly predicted the fall of Twin Towers in the United States. So the terrorist attack on the United States, she was quite vague, but she, let's say, correctly predicted that to happen. And she got a lot of media coverage. All the newspapers all around the world wrote about her. This is Humbert Angel. He is an African preacher. And he correctly predicted the year when Nelson Mandela will die. And because he correctly predicted that year, all the newspapers all around the world wrote about him. And he became famous. This is Paul the Octopus. This is the octopus that correctly predicted the results of 11 Football World Cup games in 2010. Now, how did the octopus do this? They put some food in 2 containers, and they put flags, national flags of the contenders of the next match in each of them, and whichever piece of food she took first, this was her prediction. Okay? And she was correct in 11 times. And she became a media sensation all around the world. This is John Paulson. He is a famous Wall Street fund manager. And he correctly predicted the housing crash of 2007-2008 and the financial crisis. And because he correctly predicted that to happen, and he bet, so he used financial vehicles that are gaining when the market is falling. So he was basically shorting the market. He got enormous returns during the financial crisis. He made 16 billion US dollars for him and for his investors. And he became a star of Wall Street, the #1 guru of Wall Street. So after the financial crisis, all the wealthy people from all around the world gave him their money and entrusted him with their money, and he is a fund manager, so they basically bought shares in his funds. So he got a lot of money from investors from all over the world into his funds. Now, here things get interesting. Baba Vanga, after the fall of Twin Towers, made a lot of other predictions. None of them came true. She even predicted that there will be a world war in 2010. But I'm not a historian, but I don't think that that happened. Okay? There were thousands of preachers like Humbert Angel, who predicted a lot of different things that they will happen in the world, but again, almost none of the predictions came true. The most popular prediction is about the end of the world. And there were thousands of prophets who predicted the end of the world at a certain year. But as we are all still alive, I think that that didn't happen. Paul the Octopus. After Paul the Octopus, there were thousands of owners of different animals, from elephants to worms, trying to predict different outcomes of football matches and so on. None of them succeeded. But now you will think, but what about John Paulson? He's a world expert about, financial markets. Even the book, The Greatest Trade Ever, was written about him. He's the greatest. He's the best. What about him? Here are his results after the financial crisis. When he got huge amounts of money from different investors from all around the world, his returns in the next 4 years were minus 63%. While the market, if you just invested in a simple index fund, grew by almost 70%. So his investors were losing money all the time, while market was gaining ground all the time. What about last 4 years? Maybe his luck changed. 2014 to 2018. One of his funds suffered 70% over the last 4 years. So previously it crashed by 60% and now by another 70%. And this one dropped 42%, the second one. So basically, if you just put your money after the financial crisis in a simple index fund, you would now have, let's say that you started with 1,000, you would now have 3,000. But if you gave your money to him, instead of 1,000, you would have maybe 100 now. So the difference between 100 and 3,000 is a quite big difference. So who would you like to entrust your money to? John Paulson or maybe just put it into an average index fund. So this is the key to understand. Even our famous Robert Kiyosaki. I love Robert Kiyosaki. Who loves Robert Kiyosaki? We all love him, you know. But why does he make predictions? I don't know, you know. If I were him, I would never make this kind of predictions, you know. In 2016, he said, 2016 will bring about the worst market crash in history. What happened in 2016? Nothing. Stocks all around the world were hitting record highs. The same thing he predicted in 2015, 2017, and 2018. Nothing happened. You know, he was wrong all the time. And I even wrote a very interesting article about it on my website. So these gurus are constantly wrong. And I'm not just cherry picking here. I didn't just choose Robert Kiyosaki and John Paulson because they had bad luck. So let's take a look at this study. So CXO Advisory Group made a huge analysis of 86, so they took 86 of the highest paid consultants, gurus, and stock analysts in the world, and they took their predictions from 1998 to 2012, and they analyzed them. So altogether, it was more than 6,500 predictions of these best experts. Where the stocks will go. Certain stocks will go up or down, and so on, you know. What will happen in the markets. So these were these predictions. Now, if you made 6,500 up or down predictions, in what percentage you would be right, mathematically? What do you think? No, it's just up or down. You are always making up or down prediction, what will happen with a certain stock or maybe oil price or gold price and so on. So at what percentage you will be right if you made 6,500 predictions? 50%, that's right, you know. And even if you put monkey to throw the darts, monkey would also have 50% success rate. Okay? It's a simple mathematical probability, up or down. It's just random coincidence, 50%. Now, how did the best gurus in the world, the highest paid gurus in the world fare? They were right in 46.9% of the cases. Monkeys outperformed the gurus. Спасибо. Even Robert Precher, who is one of the legends of investing, he wrote the book Elliott Wave Principle. Elliott Wave is one of the most studied theories in investing, you know. It's a very famous thing. Even he was right only in 20% of the cases. So, in 4 out of 5 predictions that he made, he was wrong. It was totally embarrassing for him. But people are still studying Elliott Wave theory and making predictions based on that, even though it's wrong most of the time. It would be better to just do the opposite. Okay? So, this is it. This guy is laughing. This guy is laughing, you know, at these experts. So, if enough people are making predictions, some of them will come true. If enough people are making predictions, some of them will come true. But you never know which ones. You never know which ones. Unfortunately, they are making predictions now, and you don't know who will succeed in the future and who will not. So that is why I never listen to the experts. I never listen to somebody who is saying, oil price will go up, gold price will go down, stocks will go up, stocks will have a crisis, and so on. I never listen to these guys, because they are wrong most of the time. So the best thing to do is just to ignore them. Ignore all the predictions about what the future will bring, and you will be just fine.